Oil prices are sliding today, and Exxon and Shell are warning of their profits taking a hit. Exxon Mobil pointing to fourth quarter earnings suffering from significant headwinds like lower crude prices and narrowing refining margins. Meanwhile, Shell is warning weakness in its natural gas division as it saw lower sales volumes and trading earnings. For a closer look at the oil market, let's get to Tortoise Senior Portfolio Manager, Managing Director, and Managing Director Rob Thummel. Rob, it's good to see you. So I am curious about these two companies in particular, right? Looking at Exxon and Shell. And, obviously the lower oil prices have been mostly a boon for consumers, but not necessarily for these companies. So what does this tell us about, not just last quarter, but how 2025 is going to get started for these companies?
Well, hi, Julian. Thanks for having me. So if you look at Exxon and Chevron, they are energy producers. So their earnings do ebb and flow a bit with commodity prices. And so as you highlighted, we've had lower commodity prices, great for the consumer, obviously stimulates demand, keeps inflation low, but does bring down earnings a bit. But if you just look at the valuations of Exxon and Chevron and the whole energy sector in general, a lot of other sectors you're talking about are at all-time or even above all-time averages. The energy sector is not. It's well below its all-time highs, while a lot of other sectors are above or beyond their all-time highs. And so that's those lower prices are priced into the market. So then it's like, then the thought is, well, what's future demand and what are future prices? And then is that a good opportunity to be buying Exxon and Chevron? And we think that you'll see steady improvement in oil prices, probably a little better improvement in natural gas prices, which will all be beneficial for Exxon and Chevron going forward and help lift their valuations.
Rob, kind of a broader question. Trump moving back into the White House. Drill, baby, drill. It's a Republican mantra, Rob, but I don't think we've had a single energy investor, analyst, or strategist come on this show, Rob, and tell us that, yes, they in fact do expect to see some kind of meaningful pickup in U.S. production, but I'm curious to get your take, Rob.
Yeah, Josh, so I think a way to think about drill, baby, drill, I think the way investors should think about it is, I think you should think about it this way. So drill, baby, drill basically means, in my opinion, that we've got a lot of oil and natural gas in the U.S. And that's thanks to this U.S. shale revolution, U.S. shale technology. So we have a significant amount of reserves across the U.S. And so what drill, baby, drill means to me is that when we need it, we'll be able to drill more and produce more. But the goal will be to keep inflation moderated and keep oil and natural gas prices at moderate levels so that they just don't get out of control. And so if prices would elevate substantially, the U.S. has the ability to increase their drilling activity, and then ultimately that results in higher production and will help keep a lid on prices really elevating significantly.
So that sounds much more like a longer-term situation potentially for some of the oil companies, because in the short term, they don't want to drill endlessly, right? Because they want to keep their profit margins intact. Is that a fair way to look at it?
That's exactly the way to look at it, Julie. I think what energy companies are ultimately doing is they're balancing. They're looking for that Goldilocks scenario where they can balance the interests of their shareholders and their stakeholders and the shareholders with obviously keeping energy demand globally, and the consumer buying buying energy products, which basically means GDP needs to go higher. So if they can balance those two well, that's kind of that Goldilocks perfect scenario. But energy companies like Exxon and Chevron and a lot of others have big dividend yields. So if you have investors out there looking for big dividend yields and steady and growing dividends, Exxon, Chevron, and a bunch of other names are really good places to look at in the energy sector.
Rob, another headline that I saw this week, which is right in your universe, came from Axios. And this week, Rob, they talked about how Trump and his advisors plan to fairly quickly return to applying, in their words, maximum pressure on Iran. Military options not off the table, according to that report. I'm just curious how the conflict, the tension with Iran, geopolitics, how that is playing, Rob, into your oil outlook in 2025.
Yeah, Josh, I think that's part of the reason why you've seen oil, ended the year and here in the U.S. around $68 a barrel. It's run up to 75 fairly quickly here at to start the year. Has nothing to do with the weather. It basically has everything to do with, in my opinion, this concern about what's going to happen with Iran. So if you sanction Iran, then and actually apply the sanctions, you're going to have basically less oil supply, because the result will be lower exports of crude oil from Iran, which basically takes supply off of the market. Now, this oil market right now is already fairly tight. Now, doesn't mean the prices are going to skyrocket because there is available supply, I guess, available, whether it's U.S. production or, more importantly, OPEC Plus that could bring back some production. So I'm not really worried about prices spiking a lot, but taking supply off the market will have a short-term impact on oil prices, and that means probably oil prices jump up a bit.
Rob, thanks a lot. Appreciate it.
Thank you.